Okay, let's get started. My name is Mark Bautis, and I'd like to welcome everyone to the Halftime 2018 presentation. We have a few disclaimers before we launch into our presentation. Today we're going to talk about what happened in the financial markets during the first half of 2018. We'll take a look at where we've been, where we are today, and where we may be going. Before we begin our review, let's get warmed up by testing your headline instincts. Telling real news from fake news has almost become a national pastime, and it can be quite challenging. It's important to question headlines because research has shown the more that we encounter a piece of fake news, the more likely we are to believe it. On each of the next few slides, you'll see two headlines. One headline is for a real news story, and the other is not. See if you can tell which one is the real headline. Okay, so for the first one, Pluto has been officially reclassified as a planet, or performing CPR, humming the Macarena could help. The Guardian reported in June that humming the Spanish dance song Macarena could save lives, according to research that suggests it helps people administer chest compressions at the correct rate while performing CPR. The Guardian also suggested anyone concerned humming the song may trigger a spontaneous desire to dance could choose another tune with 103 beats per minute, such as Your Body by Christina Aguilera, Trust in Me by Etta James, or James Baskett's Zippity Doo-Dah. Our next question, lawmakers seem confused about what Facebook does and how to fix it, or Charles Manson to be released on parole to Johnson County, Texas. The real headline is lawmakers seem confused about what Facebook does and how to fix it. After the Cambridge Analytica scandal, some members of Congress were ridiculed for asking Mark Zuckerberg questions that shed more light on what they don't know about social media than on what should be done to protect users' privacy on social media platforms. Vox suggested Americans may have asked too much of lawmakers. As easy as it is to laugh off lawmakers' confusion about Facebook or look down at their muddled lines of questioning, it's also understandable. Plenty of people have a very limited notion of how exactly Facebook business works, what happens to their data, and what they can do to increase their privacy. The second headline about Charles Manson is a fake headline that has been popular on, yes, you guessed it, Facebook. And for our third question, stronger than steel, able to stop a speeding bullet, it's Superwood. Or the Seattle Seahawks may be kicked out of the NFL for what they did in their locker room. The Seahawks headline got a lot of play, but it's been debunked. The real story is Superwood. Scientific American reported, some varieties of wood, such as oak and maple, are renowned for their strength. But scientists say a simple and inexpensive new process can transform any type of wood into a material stronger than steel and even some high-tech titanium alloys. All right, now that we've warmed up, let's take a look at where we've been. U.S. stocks rocketed into 2018. Fueled by tax reform, the major U.S. stock indices shot higher in January 2018. In fact, the Standard & Poor's 500 index hit 14 new highs in January, which was a record high number of record highs for January. Toward the end of the month, markets declined. Barron's explained it this way. On January 26, the stock market was sitting at an all-time high. Investors everywhere were marveling at what an impressive start to the year it had been and what an outstanding run stocks have had for the past 9 years, adding more than 300% from their 2009 post-financial crisis low. And then things suddenly fell apart. You can see the downturn here. Major U.S. stocks indices headed lower during the first market correction in almost 2 years. If you're unfamiliar with the term, a correction is a decline of at least 10% in the value of an index or a stock. Corrections are temporary downturns that occur during bull markets, although they usually occur more frequently than they have during this bull market. Since the correction, markets have moved higher, and they have been a lot more volatile than they were last year. The inset chart shows the last 12 months, June 2017 through June 2018. As you can see, markets were relatively calm in 2018, and in 2018, the volatility resumed. This chart shows volatility weekly from 2017 into 2018. During 2018, the highs have been higher and the lows have been lower. While that may seem unwelcome, 2017's lack of volatility was not normal for stock markets. Here you can see the number of times the S&P 500 index moved up or down by more than 1% in a single day. There were actually only 4 days like that in 2017, which is unusually low. So far in 2018, there have been 36, which is just about average for any given year. Generally, a day when the market moves up or down by 1% is considered to be pretty volatile. Fidelity explained the return to volatility like this. U.S. tax cuts and fiscal stimulus helped firm inflation and growth expectations in the first few weeks of Q1, pushing up global equities and bond yields. Then, market volatility surged in part due to an accumulation of policy risks, including a sustained commitment to monetary tightening by the Federal Reserve, an aggressive trade posture by the U.S., and regulatory concerns around large technology companies. Consumer discretionary and technology companies were the top performers during the first half of 2018. The telecommunications sector delivered the weakest performance year to date, followed by consumer staples. Consumer staples were dealt a 1-2 punch during the period. First, higher commodity prices have hurt profitability. Second, demand for consumer staples companies, which often pay attractive dividends, became less interesting to income-oriented investors as bond interest rates rose. Despite tremendous differences in sector performance, the Standard & Poor's 500 finished the first half of 2018 up. It wasn't up a lot, just 1.7%. U.S. stocks outperform emerging markets and international stocks. As you can see, the Dow Jones Global ex-US index lost 4.9% during the period, and the MSCI Emerging Markets Index was down 7.7%. In addition, gold was down 3.6%. The Bloomberg Commodity Index lost almost 1%, and the Dow Jones Equity All REIT Total Return Index finished up 1.3%. When we look outside the United States, you can see relatively few countries produced positive returns during the first half of 2018. Finland and Colombia delivered the top returns among MSCI indices, while Turkey and Brazil were at the bottom. And there where you can see U.S. was actually one of the few that did have a positive return for 2018. Tax reform helped U.S. companies by reducing corporate tax rates from 35% to 21%. You might say tax reform was the fairy godmother of corporate earnings during the transition from 2017 into 2018. For many companies, lower taxes translated into higher profits, which are reflected in companies' earnings. The sector with the strongest earnings growth during the first quarter of 2018 was energy, and the sector with the weakest earnings growth was real estate. In many cases, corporate profits were even higher than analysts anticipated. 77% of companies in the S&P 500 index reported earnings above expectations. The first quarter of 2018 delivered the biggest earnings surprise in a long time. FactSet reported, in aggregate, earnings have exceeded expectations by 7.5%, which is the highest surprise percentage since the fourth quarter in 2010. Yet, prices for the S&P 500 stocks rose just 0.2%, well below the average increase of 1.1% during the past 5 years. Why would share prices gain so little when earnings growth was so strong? Stock markets are leading indicators, so prices typically move higher on expectations. However, we're talking about earnings surprises, which are unexpected. The lack of price response suggests investors may have concerns that are holding share prices down. These concerns could include geopolitical concerns, trade tensions, rising interest rates, or rising U.S. debt levels. Improved earnings have brought price-to-earnings ratios closer to the 5-year average, although the price-to-earnings ratios remain above their long-term average. From January through late May, rates on U.S. Treasuries rose steadily and the value of previously issued bonds moved lower. Rates rose in part because investors expect the Federal Reserve to continue to increase rates to guard against higher inflation. In June, Treasury yields dropped a bit as geopolitical jitters overshadowed strong economic data. Rising rates could also reflect concerns about higher levels of national debt. Since the financial crisis of 2007-2008, the federal debt has grown significantly. The current administration's tax cuts will cost $1.9 trillion over the next 10 years, and the omnibus spending bill cost another $1.3 trillion. And because of this increase in federal spending, the government is now on track to run a deficit of more than $1 trillion by 2020. We finance our national debt, which is expected to reach actually not 1 trillion, 16.5 trillion by 2020 with treasury bonds. As our debt has risen during the past decade, treasury rates remained low because of high demand. Domestic and overseas investors shifted assets into treasuries to protect against risk. In addition, changing government regulations and the Fed's quantitative easing program increased demand. So bond prices rose even though the supply of debt was increasing. That may be changing though. The Federal Reserve explained, it appears that the growth in demand for treasuries has slowed down over the past few years. If the supply of debt continues to increase as projected, higher interest rates are likely in the near horizon. Now, rising rates could have some unwelcome consequences. For one, if more tax dollars go to repay our national debt, less will be available to fund domestic programs. CNBC provided a rough example. If the debt is $16.5 trillion in 2020 and Treasury rates average 5%, then our national debt service payment on Treasury bonds would be about $825 billion. Last year, individual income taxes produced at about $1.6 trillion in revenue. If rates continue to increase and the debt remains constant, about 1/2 of all personal income taxes would be needed just to service our national debt. That's more than the defense budget and equal to our Social Security obligations. Concern about the national debt could be one reason share prices haven't risen with earnings. This is one reason some investors may have suggested that returns in emerging markets may prove to be more attractive over the long term. Although that hasn't been the case so far in 2018. It's been a tough year for emerging markets, in part because of the strong economic performance in the US. Financial Times described it this way. Signs the US economy is in a robust health have left fewer investors interested in emerging markets and prompted a rethink on weak growth figures and mounting debts in countries like Argentina, South Africa, and Brazil. Turkey was affected more than other countries. In part, this is because the president has demonstrated a misunderstanding of economic fundamentals, suggesting higher interest rates are responsible for rising inflation when rising rates are a tool used by central banks. An emergency rate hike by the Turkish central bank in June helped soothe some of the investors, but the concerns still remain. Despite lackluster performance year to date, research from Morgan Stanley suggests emerging markets, especially the Asia-Pac region, have tremendous potential over the longer term. Asia's total equity market capitalization could double over the next decade to $56 trillion, overtaking North America as the largest equity market region and accounting for more than half of the growth in world equity market capitalization. Okay, so now let's turn our attention to Europe. Growth in the Eurozone also slowed during the first half of 2018. There were many reasons for the slowdown, including declining consumer confidence, lower household spending, concerns about stability of the European Union after Italy elected an anti-establishment government that may abandon the euro, also uncertainty heightened tensions over trade with the United States. Okay, so let's take a look at where we are today. All right, we in the United States are relatively happy. The 2018 World Happiness Report showed the United States ranks as the 18th happiest countries among the 156 surveyed. We're not as happy as we were from 2008 to 2010, but we're happier than many nations. Happiness derives from a variety of factors, and each segment reflects a different factor. So some of the factors are the gross domestic product per capita, social support, life expectancy, freedom to make life choices, generosity, perception of corruption. The final segment is the sum of two components. The first component is a fixed number representing the 2015 to 2017 ladder score for a hypothetical country called dystopia, signified by the light purple. Dystopia has values equal to the world's lowest national averages for 2015 to 2017. The second component is the 2015 to 2017 residual for each country, which is typically the part of the national average ladder score that is not explained by our model. If gross domestic product, GDP growth, were the sole determinant of happiness, then Libya would be the happiest country in the world. It was actually number 70 for happiness. Its economy is expected to grow the most quickly during 2018, according to the International Monetary Fund, and it's expected to grow at 16.4%. And that's the dark green shaded country at the top of Africa. Around the globe, GDP, which is the value of all goods and services produced, is expected to average 3.9%. Advanced economies are expected to average 2.5% growth, and emerging economies are expected 4.9% growth. While it's great to see most countries are expecting decent growth, risks remain. And we already talked about one of them, which is rising U.S. debt. But here are some other ones. This matrix from BlackRock identifies geopolitical risks and indicates the relative likelihood and potential impact each will occur. So if you look at the chart, the risk with the greatest potential impact is also one of the most likely to occur, and that's U.S.-China relations. The concern was that the United States would impose tariffs, which are taxes on goods imported from other countries, on Chinese goods, and then China would retaliate with tariffs on U.S. goods. These tit-for-tat responses would therefore spook the markets. In early July, after the United States imposed additional tariffs, China announced that the United States had started the largest trade war in economic history. North American trade issues were considered a lesser risk when this matrix was published. Since then, one of the escalation triggers, the United States imposing tariffs on Mexican and Canadian goods, has occurred. It's typical for 2018. Things have been changing very fast. In March, President Trump exempted Canada, the European Union, and Mexico from tariffs on steel and aluminum until June 1st. He granted permanent exemptions to Argentina, Australia, and Brazil. However, on June 1st, a 25% tariff on steel and a 10% tariff on aluminum were imposed on Canada, Mexico, and the European Union, as well as other countries. The administration said that the tariffs were needed to protect national security. The affected countries disagreed and retaliated by imposing tariffs on U.S. goods. The Economist said American trading partners are promising tariff retaliation that could affect as much as $43 billion of its exports. They have picked products ranging from motorcycles to pork. Retaliation adds to worries that Mr. Trump will harm America's economy, not help it. U.S. tariffs on imports, which raise the price of imported steel and aluminum, could negatively affect American companies and slow economic growth, according to research published by Econofact. Jobs in U.S. industries that use steel or inputs made of steel outnumber those involved in the production of steel by roughly 80 to 1. This map shows where the majority of those jobs are by state. After markets rallied off the lows in February, trade quickly rose on the list of investor concerns. Investors are rightly concerned a trade war would harm earnings growth at firms that have become reliant on the global supply chain. Our economy, especially the companies in our portfolios, are organized around the relatively free flow of goods into and out of the United States. For example, the Boeing aircraft on this slide is both made and sold all over the world. Trade benefits every country. At the same time, it's clear that some countries, particularly China, have benefited more from free trade than the United States. China's trade surplus with the United States is exacerbated by barriers against U.S. firms entering the Chinese market and forced technology transfers from U.S. firms to Chinese joint venture partners. Our expectation is many existing trade deals will be renegotiated and contain modest benefits to the United States relative to foreign partners. The gains may be enough for the administration to claim a political victory, but not enough to upset global growth. Tariffs on American exports could also slow productivity. WrestleInc, a supply chain consultant, created this chart showing how various companies with China-based supply claims could be affected if what happened with our allies also happens with China. A key worry is the global system of trade, a system the United States has helped build, could be damaged by tariffs and trade wars. The The United States could be vulnerable on another front as well. One of the U.S.-China escalation triggers identified by BlackRock is China retaliating in a meaningful way, either through trade measures or to an adjustment to U.S. Treasury purchases. China is a major purchaser of U.S. Treasuries. If they begin to purchase fewer, then rates may rise higher in the United States, impeding the government's ability to spend on key programs. Reuters said China held around 1.17 trillion of U.S. Treasuries at the end of January, making it the largest of America's foreign creditors and the number 2 overall owner of U.S. government bonds after the Federal Reserve. Any move by China to drop its Treasury portfolio could inflict significant harm on U.S. finances and global investors, driving bond yields higher and making it more costly to finance the federal government. Concerns about trade tensions led to a significant shift in investor sentiment during June. During the last week of June, there was a tremendous increase in the percent of investors with a bearish outlook and a drop in the percent of investors who were bullish or neutral. The historic averages are bullish sentiment at about 38.5%, neutral sentiment at 31%, and a bearish sentiment at 30.5%. So you can see we're a little more bearish than usual. All right, so now let's turn our attention to the future and talk about where we may be going. Here's a hint. We're not going to the movies. Movie theaters in the United States and Canada sold 5.8% fewer tickets in 2017. Those were the lowest attendance numbers since 1992. It doesn't mean Americans don't love movies, they're just not watching them in the theaters anymore. Let's take a minute to test your movie knowledge with some favorite quotes. Okay, which movie character said, "You're going to need a bigger boat"? Was it Jack Sparrow in the Pirates of the Caribbean, Sheriff Brody in Jaws, Dr. Dolittle in Dr. Dolittle, or Hector Barbossa in Pirates of the Caribbean? All right, the correct answer is Sheriff Brody in the movie Jaws. All right, we started off with an easy one. All right, which movie character said, "Well, here's another nice mess you've gotten me into"? Was it Shrek in Shrek, Oliver Hardy in Sons of the Desert, Dory in Finding Nemo, or Wallace in Wallace and Gromit: A Grand Day Out? The correct answer is Oliver Hardy in the movie Sons of the Desert. All right, on to the next one. Which movie character said, "Happiness can be found even in the darkest of times if one only remembers to turn on the light"? Was it Happy Gilmore in Happy Gilmore, the donkey in Shrek, Professor Dumbledore in Harry Potter and the Prisoner of Azkaban, or Achilles in Troy? The correct answer is Professor Dumbledore in the movie Harry Potter and the Prisoner of Azkaban. All right, I think this is the last one. Which movie character said, "Don't you see what's happening? Potter isn't selling, Potter's buying." And why? Because we're panicking and he's not. That's why. He's picking up some bargains. Was it Ricky Roma in Glengarry Glen Ross, George Bailey in It's a Wonderful Life, Draco Malfoy in Harry Potter, or Ernest Tilly in Tin Men? The correct answer is George Bailey in It's a Wonderful Life. All right, back on to where we may be going. As the United States moves into the latter stage of current expansion and investors begin to look forward to the future, George Bailey's observation will be important to remember. Even during economic downturns and bear markets, there are opportunities to be found. As the chart shows, markets and economies tend to move in cycles. Markets often change direction before economies do because investors are always trying to predict what's ahead. For quite some time, the global economy has been experiencing a steady expansion. Developed countries, for the most part, are in the latter stages of this expansion. The next stage is contraction. One of the drivers behind rate hikes is inflation. In the United States, inflation has climbed within the Federal Reserve's target range of 2%. The Fed has increased rates to try and keep inflation in that target range. Rising interest rates could be a catalyst. Currently, the Fed is expected to raise rates 3 to 4 times during 2018. While monetary policy differs from country to country, the Council on Foreign Relations Global Monetary Policy Tracker shows global monetary policy is tightening overall. The CFR says the summary index of global easing color bar can be found just above the map. The index ranges from -10, which is the dark blue, to 10, which is the dark red, where -10 indicates that all countries are easing, which was the case in late 2008, and 10, which indicates that we are all all are tightening, as was in mid-2006. In generating the index value at any point in time, each country's monetary policy stance is weighted by its currency's share of global foreign exchange reserves. The United States, therefore, receives a 61% weighting. The global map, the second part of the CFR data, illustrates which regions of the world are easing or which are tightening. So what do money managers and analysts make of the current economic conditions? The Economist Intelligence Unit expects growth with less enthusiasm for the remainder of 2018. The global economy continues to grow at a healthy rate, although the buoyant mood of the last quarter of 2017 has become more tempered. In our view, 2018 will be characterized by tightening monetary policy and credit conditions, increasing risk to global trade, and deeper geopolitical concerns in the Middle East. FS Investments chief U.S. economist Laura Ram says we'll probably see slower growth over the long term. Real GDP growth has trended lower over the last 50 years, caused primarily by slowing labor force growth and productivity. Positive cyclical momentum caused growth to pick up in the second half of 2017, and optimism is high that 2018 will see a further boost from pro-growth policies. Yet the gravitational pull of structured headwinds is powerful, and over the long term, we believe investors may need to prepare their portfolios for a lower for longer growth environment. Ben Bernanke is not a fan of the recent fiscal stimulus. During an interview at the American Enterprise Institute, he commented, "The Trump administration's tax cuts and spending make the Fed's jobs more difficult all around because what you're getting is a stimulus at the very wrong moment. The economy is already at full employment, so you're getting a hit by a big stimulus. It's going to hit the economy in a big way this year and next year and into 2020. Wile E. Coyote is going to go off the cliff and look down." Professor John Hussman, who is well known for his bearishness, isn't expecting great things. In May, he wrote, "Presently, we observe a particularly dangerous pairing of extreme valuations and deteriorating market internals. Coming off one of the most extreme periods of overvalued, overbought, overbullish enthusiasm in market history, and coupled with hostile yield pressures and widening credit spreads in debt markets, the current set of market conditions is easily among the most hostile in history." Jenny Johnson, president and COO of Franklin Resources, recently emphasized the importance of a risk-adjusted portfolio. She said, "When money just goes irrationally into stocks without some fundamental review, we think there is a risk. There's a place for both active and passive investment, but a risk-adjusted portfolio is really important. My investment advice is to have a diversified investment portfolio and not put all eggs in one basket." Okay, so we've spent a lot of time discussing what has happened so far during 2018 and what may be ahead. Considering the economy and markets isn't enough. We also need to understand how your lives may be changing. Perhaps one of your children is marrying, or a new grandchild is on the way. Maybe an illness or death has changed your family's circumstances. Maybe you decided to pursue a new career or start a new business. No matter what is happening, big changes or small ones, these events play an important role in your finances and the strategies we pursue to help make the most of your money. So please, let us know what's changing in your life. Okay, I'd like to thank everyone for joining us, and if anyone has any questions, I'd be happy to talk.